This podcast includes information provided by the issuer and does not express the views of the interviewer. This podcast may also include forward-looking statements by the issuer that involve certain risks and uncertainties to its business. Because forward-looking statements are subject to risks and uncertainties, the issuer's actual results could differ from those indicated in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And you're listening to episode 85. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rkraft@snnwire.com. And when you do get a chance, if you like what you hear, please rate and review Planet MicroCap on iTunes. It really helps provide feedback for me and spread the microcap message. For this episode of the Planet MicroCap Podcast, I spoke with Jesse Felder, founder and editor of the Felder Report. Jesse is a well-respected money manager who began his career at Bear Stearns and later co-founded a multi-billion-dollar hedge fund firm located in Santa Monica. With over 20 years of experience, I reached out to Jesse with the hope of learning his beginnings and how his investing journey has changed, or not, over the years. What I came to learn from this interview, which we talk at length about, is how insider activity affects Jesse's investing strategy. Thank you again for tuning in to episode 85, and please enjoy my interview with Jesse Felder, founder and editor of the Felder Report. But first, a word from our sponsor. To my loyal listeners, subscribers, and fans, Robert Kraft here, your host on the Planet MicroCap Podcast. The 2019 Investor Conference season is upon us. Where are you going this year? I'd like to take a second to invite you to join me and maybe a few of the guests you've heard on this podcast to our annual MicroCap Investor Conference, the Planet MicroCap Showcase, April 30th to May 2nd, 2019 at Bally's Hotel and Casino in Las Vegas. The Planet MicroCap Showcase will be 2.5 days of company presentations, networking opportunities, an educational workshop, and you will get to meet privately in one-on-one meetings with the management of well-known emerging growth private and publicly traded microcap companies. We are back with new surprises and programming that you will not want to miss. So join us for the Planet MicroCap Showcase, April 30 to May 2nd, 2019 at Bally's Hotel and Casino in Las Vegas. For more information and register to attend, please visit www.planetmicrocapshowcase.com. See you in Vegas. For this episode of the Planet MicroCap Podcast, I would like to welcome Jesse Felder, founder and editor of the Felder Report. Jesse, welcome to the Planet MicroCap Podcast.
Hey, glad to be here, Robert. Thanks for having me.
It's great to have you on. So as we normally do here, I want to get your background. How did you get your start investing and in the world of finance?
Well, it was interesting. I didn't study finance in school. I had always had an interest in it since I was a kid. I actually started kind of paper trading, I guess. I didn't know what it was called at the time, but when I was like 8 or 9 years old, I started becoming interested in the stock market. And then I didn't study it, but after I graduated college, I thought, I've always had a passion for this. Why don't I see if I can get a job in the world of finance? And I interviewed all over LA, Morgan Stanley and a couple different places, and finally got a job at Bear Stearns. And so I went to work at Bear for a couple of the most successful guys, probably the most successful guy in the LA office, and quickly realized I didn't want to be a salesman, so I had to find somewhere else there to work. I found a guy who was basically running a hedge fund inside of Bear, and I went to work for him more specifically, and I basically was running every trade that he did. So I got to learn firsthand, from him, and it was quite the experience. So that would have been like mid 1990s.
Mm-hmm. So then from Bear Stearns, according to your bio, you then went and started your own hedge fund. Right.
Yeah. So I left with the guy at Bear who I was working with, and we started a fund with about $100 million under management. And actually, it was not just one fund. We started three funds. We had a long short fund, we had a long only fund, and then an income focused fund. We also managed separate accounts, and we had our own broker dealer. So essentially, he was the lead portfolio manager. I was assistant portfolio manager and head trader. And then we had a few other kind of support people that we hired. It was quite the experience. We also had, with our own broker dealer, I had a couple of other hedge funds, New York funds, that were doing, processing a ton of their trades through me, so through our trading desk. So it was, and that was right up, from 97 through the peak of the .com mania. So I had a front row seat to a lot of that stuff. It was quite an experience.
Mm-hmm. But you were still, again, according to your bio, you were still able to grow that fund from 100 million to a multi-billion-dollar hedge fund. Just for clarification, am I correct there?
Yeah, we started with 100 million. By the time I left, I left in March of 2000. And it was probably up to $1 billion at that time. It eventually grew to 10, 11 billion by 2011, 2012, something like that. But at that point, it was when it all kind of came crashing down, and my two former partners sued each other, and the SEC sued the fund, I left in 2000 because I didn't see quite eye to eye with my partners in regards to ethical kind of things. So. Yeah, they continued to grow it, but I got to the point where I wanted no more to do with it, and like in most of my investments, I was way early, but that was my hedge fund experience.
So then, just to finish off your background, I mean, so you left there in 2000. We're in 2019. What have you been doing for the last 19 years?
Yeah, so when I quit the hedge fund, I had several people that wanted me to manage money for them. They're pretty much just some friends and family. So I did that through 2014, and that was just some separate accounts that I managed. And at the end of 2014, I decided to give them their money back and say, I just can't charge you a fee to when I'm not finding a lot of ideas. To me, by the end of 14, stocks had become very expensive. The risk reward generally had become very unattractive, and I wasn't going to charge them money to be in cash and wait. And at the same time, around 2005-06, I started writing about the markets, and really found that I enjoyed that a lot more. The research and writing side of it to me was just much more suited me. A lot better, and there's so much with the business side of managing money that is unattractive to me, from dealing with clients to raising money to all those types of things. You look at a lot of the successful firms, and they spend all their time marketing rather than actually doing the research and that sort of stuff. So I found that I'd rather spend time doing what I love, which is research and writing about markets.
Mm-hmm. And also I found in even just doing this podcast and talking to some of the people I've had on here, is most of them they started their own blogs because they just wanted to get better. It was a chance for them to write out their theses and either have it critiqued, by others because it's public, but at the same time, it helped them really hone in on what was important to them, to their investing thesis. It sounds like you had a very similar approach.
Yeah, absolutely. Actually, that really wasn't the impetus when I first started writing in 2005. I started the blog because here in Bend, Oregon, we were, it's hard to imagine. We were really kind of the epicenter of the housing bubble. Our little market here, was the either one or two most overvalued real estate market in the country back in 2005. And so it was just, I had seen the .com mania firsthand. We had several, investors who were trading through our hedge fund at the time, and I kind of witnessed that firsthand, and then I saw that replay again so quickly, just 5-6 years later, in the housing mania, and here in Bend, it was just absolutely insane. I mean, you couldn't go to a barbecue without every single person you talked to telling you about how much equity they pulled out of their primary residence and how many homes they could parlay that into. And I mean, I literally knew people that here in town had taken one house and parlayed it into literally 16 or 18 investment properties at the peak of the mania. And so it was absolutely wild to me to witness this. So that's really why I started writing. But you're absolutely right. One of the fringe benefits, and it's probably the greatest benefit I've gotten from writing, was it's really attracted a lot of like-minded people and started dialogues with, for me, a lot of valuable dialogues with interesting people. And so that has been, very, very valuable to me in that regard.
Mm-hmm. So my next question's it's now a 3-part question. So hopefully, if I got to repeat it, it's no problem here. So Jesse, what was it like going? This is going back to your start in the world of finance. What was it like going from working at Bear Stearns to running your own multi-billion-dollar hedge fund, and then also going from working to there to just managing friends and family money? And along the way, did your approach to investing change when you went to each step of your career?
Yeah, my personal investing philosophy has been constantly evolving. I'm constantly trying to discover new things. I mean, I think everybody, when you find what you're really passionate about in life, you kind of have an insatiable curiosity about it. And so I'm always looking for, new methodologies and things to kind of integrate. But yeah, I mean, it really just started out at Bear Stearns. Like I said, I went to work for a couple of guys who were essentially very, very successful salespeople, and they had very little knowledge about how to make money in the markets. And then when I went to work for kind of my mentor after that, still at Bear, he really started introducing me to a certain type of analysis. And really what founded the basis of our hedge funds was insider activity. So we very closely monitored insider buying and selling. And, we would see companies, and when we moved to the hedge fund, this got much more, detailed type of analysis. So we had a relationship with CFRA, which is now a big, research firm. But back then they were much more boutique and geared towards hedge funds. And so we would find, like semiconductor companies, for example, where you would see the CEO, CFO, just sell off all their stock in one quarter. And then we would, look at the cash flow statement, or, a firm like CFRA would, have some type of like a red flag based on the financials. Usually it seemed like it came back to the cash flow statement, where you'd have, cash flow somehow, lower than net income, which to me is always a red flag. Cash flow, there's very few circumstances where cash flow can justifiably, be below net income. Mm-hmm. And a lot of times that's just aggressive accounting. And so you could see, from an inventory standpoint or receivables or whatever, sometimes in deferred revenues, you could see a company getting aggressive with the accounting to try and make a quarter. And then they make the quarter, then the insiders dump all their stock, and then you would see the stock just get hammered that next quarter or quarter after that at the latest. And so to us, we found this kind of sweet spot where we could, put together this type of fundamental analysis with a careful evaluation of what insiders were doing. And it gave us a really significant edge on especially on the short side at that time. Mm-hmm. Since then, I found much more of an edge on the long side in terms of that insider stuff. So probably the only additional thing that I've done since then is, obviously having experience in analyzing, this stuff over long periods of time, you see the same things over and over. So that's valuable. But I've started to add more kind of technical analysis to the process, and it's really just more like momentum analysis. So, I even if something has good insider buying and looks cheap, if it has very strong downside momentum, I'll be relatively cautious. It's when all those things kind of work together for me. When you find something that's cheap, has attractive insider buying, and usually when I say attractive insider buying, I mean like predictive insiders. I look at their track record, and they have a really good record at kind of timing their own stock price, which should be insider trading, but it's really not in most of these cases. And then when you have momentum kind of confirming that these things are working in the right direction for you. The market's telling you that you're right. To me, those are the opportunities where I really want to load up the boat, and maybe I find one or two of those a year, but that's kind of the things I'm looking for these days.
Mm-hmm. So I actually, just to quickly follow up on that, because I think I just heard you do another interview where you were talking about stock buybacks and how this has kind of been a big fad right now, most CEOs are looking in to go and buy back their own stock. So, I mean, have they been listening to the Jesse Felder podcast and telling them, hey, this guy buys, when he's looking at companies that are buying back their stock and then, that's in essence artificially inflating the price. I mean, what's your comment on that?
Yeah, I mean, I think, the stock buybacks weren't necessarily outlawed in the past, but companies didn't pursue them for fear of being prosecuted for stock manipulation. So after the 1920s and the 29 crash and all that, there was a lot of new laws and regulations and stuff that came in because, at the time there were trusts that were developed. And so they were like buying trusts. People would put a bunch of money together and they would consciously, specifically manipulate the share price higher. You read Jesse Livermore, you read Reminiscence of a Stock Operator, or the Boy Plunger, the Jesse Livermore biography, and he talks about that. He was hired by these conglomerate, or just like groups of people to manipulate the stock price. And so after that, stock price manipulation was essentially outlawed. Corporations really didn't do buybacks until the early 80s, and that's when the Reagan administration said, look, we're not going to prosecute you for manipulating your stock price if you buy back stock. But to me, it's so obviously manipulation that it probably should be regulated to some extent. To me, I don't understand why companies can't just do tender offers. Just do a tender offer, right? You don't need to go out in the open market and push the stock price up through open market purchases. And if really you had the long-term shareholders in mind, you wouldn't do that. You would actually do a tender offer and say, we're willing to buy this number of shares at this price. Anybody who wants to take us up on that can do so. Mm-hmm. And that way you're not manipulating the price, of a stock. But the executives have a huge incentive to manipulate the share price higher. So, you probably read my blog post on the topic because, there's studies that show that when companies are out in the market buying their shares back in, insider sales go up, like 300 or 400%. And so it's pretty obvious, that insiders use that opportunity to, when they know there's going to be demand for shares, to use that opportunity to sell. And so that's a huge conflict of interest, right? Either the stock price is cheap enough and it makes sense for you to do a buyback, and in that case, you shouldn't sell your shares. Or it's not. And if you feel like your price is overvalued or whatever, and you want to sell your shares, then why are you doing a buyback? So I know that Congress has there's a couple Congress people looking at this now because the SEC recently came out with a report on the topic suggesting that this is a clear conflict and they might have to regulate that in some way, saying if you're going to do a buyback, you can't sell stock within a certain window. So I think that's a good first step, probably.
Mm-hmm. So in terms of your thesis, because this is interesting, I've had many people on where they do, they look at insider buying. They want to see, especially in microcaps, they want to see that management owns a significant portion of the company. So, they have plenty of skin in the game. So at least in the microcap side of things, you like to see that. You like to see that they're going out and buying shares on the open market. So, in your experience let's say on the long side of your insider, of your thesis, what are some things that signal, okay, this is a good reason for them to go in and buy more shares of their company?
Yeah, so I mean, for me, it goes back to just old school fundamental analysis. I look at usually a company's valuation in a few different respects. I'm very, my least favorite is probably a discounted cash flow model, but I do use that. But I like to look at a company's valuation history. You can really tell a lot, if you look at 20 years of a company's history, or even 5 or 10. You can start to see a range of when the stock is expensive, when the stock's cheap. And I used to, back in the hedge fund, we used to get Value Line, and I would literally just flip through Value Line every week. I'd look through, and that's what's cool about it, is they show the value line, and it was basically like the valuation history, and you could see, is it above the value line or below the value line? And to me, that was just like an analog, way to screen for stocks, and I would just flip through and watch, look for the stocks that were most furthest below their value line. And so I still do that, but it's in a different respect. I'm basically just looking for stocks that are trading at the low end of their own valuation history. So that's kind of where I begin. But I come back to Jesse Livermore again. There's the quote. I'm going to mangle it. I'll paraphrase it. It says, whenever a stock trades below its intrinsic value, the insiders will always come in to buy shares. Nobody knows better than them what intrinsic value is. And so to me, when I find a cheap stock and there's no insider buying, or if there's insider selling, to me, that's not management confirming my opinion that the stock is cheap. And that's really what I want, is nobody knows better than they do. And so if the stock is really cheap, they should be buying.
Mm-hmm. So what about I'm curious. I want to go through some situation analysis too, because in microcaps, there's sometimes that owner operator who's been in the business forever, let's say the 7 to 10 years, and they never sold a share of stock, but now all of a sudden they're like, all right, well, I want to sell some of my shares. I need to pay for whatever it is. Who knows? It doesn't even really matter. So what happens in those situations where you see, an anomaly in terms of the insider activity?
Well, I mean, yeah, there's always, I guess the saying is, there's only one reason to buy. There's tons of reasons to sell. And so,
right.
I mean, these guys, a lot of times they're just diversifying. So it's really much more difficult to parse the insider selling than it is the buying. For me, what really demonstrates significant buying is when guys start buying in multiples of their annual salary. So, I mean, you can look it up in the SEC filings. A guy is making $350,000 a year. If he goes buys $1 million worth of stock, to me, I read that as he's willing to forego 3 years of salary in order to be, have that pay come in shares. To me, that's interesting. But when I see guys, who make 350 grand, they're buying 20, 30, 40 grand worth of stock. I mean, to me, that's more likely they're just trying to paint the tape and get people interested, So, you can also look back and see, okay, what does this guy's buying history look like? What happened the last time he bought? And so to me, a lot of people say, well, hey, you looking at this buying? And I go, well, yeah, the guy's been buying from 50 all the way down to 25. To me, the guy clearly doesn't know what he's doing in his own shares. And so you can look back. I mean, and you can find in some companies where guys literally pick the bottom over a 10-year period, and they'll buy a ton of stock right at the right time, and the shares will rebound. And so that's just them knowing, that the stock is cheap, and that maybe this one quarter was bad, next quarter is going to be good. And so to me, I look for those guys. But I want to make a point too about, you said owner operators, because I really think this is, this comes back to the passive investing thing. And I think a lot of people don't know that the passive indexes, the S&P 500 index, was changed, 13, 14 years ago to go from not just a market cap weighted index, but to a float adjusted market cap. And so that was a major change that I think most people aren't aware about. And it actually means that the indexes now systematically are owner-operated companies. They are underexposed to those companies, because those companies that have lower float, because the insiders own a ton, are going to be systematically underweighted by the indexes now because they have low float. And the companies where you have tons of float, because there is no insider ownership, those are going to be overweighted by the index. And so to me, it's completely backwards from the way that I want to invest. And I think it's going to be a problem over time for the indexes. Probably the best example of that is you look at Intel under the helm of Andy Grove. When Andy Grove owned a third of the shares or something, the stock from the 80s, to 2000 went up, however many 1,000%. In 2000 or whatever it was, 2001, Andy Grove sold all of his stock, retired as CEO, chairman, and the stock has literally not gone anywhere since. So you made a ton of money owning Intel shares while Andy Grove was an owner-operator. As soon as he sold his stock and quit, Intel's made you no money over the last 20 years. And so to me, that's kind of an extreme example of the problem with focusing on the indexes. And also why I think it's really exciting that these companies are systematically kind of left for dead by the indexes. It leaves a lot of opportunity for people like your listeners who are looking for those types of things.
Mm-hmm. And real quick, before I go on to my next question, do you happen to own any shares or were a shareholder in Intel?
No, I don't think actually I'm short semiconductors right now. So I'm not directly short Intel, but I'm short the semiconductor ETF.
Gotcha. Has the type of information or the information feed changed over the years in terms of, because it sounds like you've always focused on insider activity. I mean, has it been more or less difficult in getting that information and then being able to continue to maintain the edge that you've had?
I think the information's gotten better. There's a couple of websites I love. One was developed by my friend Asif Surya. It's called Inside Arbitrage. InsideArbitrage.com. That's a great site. He actually puts out a weekly newsletter highlighting the most important sells and buys of the week. Another one I like is OpenInsider.com. But these websites with this public information available to everybody were not around 10 years ago. So I think the information's more available. What I do think is, people don't necessarily do, why I feel like I still have an edge is because people look at any kind of buying and go, oh, great, their insiders are buying, I'll buy some, rather than doing the rest of the work and realizing, okay, because I do think it takes some parsing to figure out, okay, is this just painting the tape? Are these guys really bullish? And there's certain guys that I've followed throughout my career. Bill Stearns is probably the number one guy who, when Bill Stearns is buying stock, I sit up and take notice because the guy has such an amazing track record from Ralston Purina to Ball Corp. For example, Ball Corp was a smaller cap company, made glass jar maker, aluminum cans maker. In the dot-com mania, nobody wanted to own this stock. He took the company over, put his own management team in, bought like $40-50 million worth of stock, and it's been like a 40 bagger since then. So, I mean, the guy's just phenomenal when it comes to running companies. He was in a book called The Outsiders. He was featured, and still people don't know who Bill Stearns is. So, I mean, there's guys like that who I pay attention to, and so I still feel like there's tons more information out there, but knowing what to do with the information is still a skill, I think.
Right. And real quick again, we're a shareholder in Ball Corp.
I was a shareholder for Ball, and I sold it way too soon.
That's funny. So now I want to apply your insight on insider activity and your track record and all of your knowledge to microcaps, and really the focus of this podcast. So what would you say for those who are focused in this asset class, ways in which they can take what you've learned and your expertise and apply it so that they can find companies early and often?
Yeah, I mean, I think probably this is the one area where you can find value in the market, things outside of the Russell 2000 that are owner operated. I mean, to me, that's probably the most fertile place to look for value ideas, because with this huge push to passive investing in recent years and all this money that's come out of active, there's literally no money looking at these things. And like you said, you might have to find them and sit on them for a while before they start working, but eventually they'll work. I mean, Buffett said in the short term market's a voting machine, and long term it's a weighing machine. Maybe it was Ben Graham. But when you find these things, they will work eventually. And I think that's really probably the only place to find them is things that are outside the purview of the indexes, and that's small and owner operated.
hmm So then once let's say we found a basket of some of these companies that fit your criteria, then in terms of when you're evaluating the insider activity for these companies, what are certain things that you look for that might be different than, let's say, a small cap or a large cap company that is also doing similar things?
Well, I've found a few of these just through insider buying, and they're always super obscure companies that I've never heard of before, and so
Sure.
it takes a ton of research to kind of understand the business model, and some of them, because they're small, and I mean. I have, bought a couple of them and sold them again too soon before they started working. And so, I really think it's, and the hardest part about it is when the executives are super bullish and are buying up stock. So this is the opposite of what we're seeing with, stock buybacks and massive executive sales. In these situations where you have a microcap and the executives are super bullish and they're buying as much stock as they can, they're trying to keep the bullish message kind of hidden from view because they want the stock to stay cheap so they can buy up as much as they possibly can over a period of time. So it's sometimes really difficult to kind of ferret out what's really going on and why are they buying and why are they bullish, because they're really kind of tight-lipped about it. And to me, that in itself can be a very bullish sign that they're not out promoting. They're not on a Wall Street roadshow trying to promote the shares. They're literally just buying stock, quietly buying stock, and putting up good quarterly numbers. And so to me, it's much more difficult in the microcap side because those guys are literally the opposite of some of the in the massive market cap companies. You have like Nvidia, which I'm short through the semiconductors. A super promotional CEO who's literally doing everything he can to prop up the share price while insiders there sell a ton of stock. So it's kind of the opposite where they're just quiet and buying. And so it's a little bit more difficult. But I take that quiet buying in itself as a bullish sign.
Mm-hmm. So then my next question is in terms of on the microcap side as well, is it, and I had this question written out, is that at any time did you focus on or have some exposure to smaller microcaps either personally or in your fund, and saw that as a place where it as a new investor potentially to really learn about the markets and really develop a good fundamental thesis?
I think it's, I mean, I have owned small caps and micro caps on and off, through time. Probably the best example that I don't own anymore was Red Hook Ale, back in the day. I think it's Craft Brewers Alliance now. But this was a stock that, they built like $50 million brewing facility. So here in Bend, I know, we're like the microbrew capital of the universe in terms of microbreweries to per capita. And so, I know a lot of the different people in the beer industry and all that kind of stuff. And I saw this Red Hook. They had built a brand new $50 million brewing facility up in Seattle, and this was during the time when micro brewing was really taking off. So this was like mid 2000s, and they were only utilizing like 30 or 40% of the capacity, and so they were just kind of burning cash every quarter. But they really didn't have much debt, and they had the assets on the balance sheet. During the financial crisis, this stock sold off so hard that, I mean, it was literally trading for less than half of the brand new brewing facility cost them to build. So it had like a $20 million market cap or something. It's trading under $1 a share. And so I'm looking at this and I'm going, this is a classic Ben Graham kind of net. You could buy this whole company up and literally just sell its brewing facility and double your money. And so to me, that was just super attractive. I think there was some small insider buying, but the funny part about the story was, Deschutes Brewery is based here in Bend. They're one of the biggest micros in the country now. I called up Gary Fish, who was the CEO of Deschutes, and Deschutes was really running out of brewing capacity. They were using 100% capacity. I said, Gary, let's start buying up some Red Hook stock, and then you buy up 10% of the shares, and then you can say, hey, I'll use the rest of your brewing capacity up there in Seattle, and I'll have just another distribution thing up there. He thought, great idea, Jesse, but those guys are buddies of mine. I can't go buy their stock behind their back. So he didn't end up buying any Red Hook. But Red Hook stock went from about under $1 a share to I think it was like $8 or $10. Only a few years later. And so to me, yes, that when something has a $20 million market cap, there are no funds or anything that can buy it in any meaningful size. And so it's literally that's where you find things that are left for dead. Mm-hmm. And so to me, yeah, there's really can be some terrific opportunities there that you can find there that you can't find in bigger stocks.
Mm-hmm. And I have to ask you this question. My audience might think I'm catering to my microcap cause, but I'm going to ask it anyway. I know you tend to focus more on the macro markets, but why would you say that microcaps don't get the same kind of coverage when there is so much out there that supports that? Not only is this a great place to learn about investing, but there's still opportunities here.
Well, I mean, yeah, because the money, on the research side of things is all, geared towards institutional investors and all that kind of stuff. And so, institutions are just too big, right? I mean, you have a $20 million market cap. Any institution that with any kind of money at all would have to buy up the entire company to have any type of exposure to it. And so they can't, they could do all the research they want and they could buy up, 10% of the stock and it still wouldn't have make any difference at all on their returns. And so that's why this stuff is just ignored, is because it's just not big enough to make a difference to institutions. And for that reason, there's just no institutional research or anything that goes into it because there's really no money in it for Wall Street. Mm-hmm.
So then another question I have, and this is based actually on a blog post that you did. Again, you tend to focus mostly on you have a more macro perspective when assessing the markets as a whole. So what changes would you like to see that would make equity markets more efficient, in your opinion?
Well, it's really interesting with this big move to passive investing. And I think I've seen some studies that, more than 50% of the market's going to be passively invested at some point this year. And the problem with that is passive investing is really based on the efficient market hypothesis. Mm-hmm. So the only way it would make sense is if, the market is actually efficient. The problem is the more passive investors you get, the less efficient it becomes, right? Because the whole efficient market hypothesis rests on the idea that investors are doing research and that stocks are priced based on that research. And so when you lose active investors in the markets, you lose that influence. And so prices are not necessarily to the extent markets become more passively influenced. Stocks move not so much on fundamentals, but simply on flows. And so I think a lot of people don't realize either that the biggest algorithms in the markets right now are basically just, or the most simple algorithms in the markets are just passive investors, right? They get flows into a fund, it triggers a buy. They get flows out of a fund, it triggers a sell, and those are just computer buy and sell orders. And so, I think we're at the point now where the market is being driven largely by flows rather than by actual research. And so, to me, that is potentially destabilizing for the broad market, but it also creates terrific opportunity for people who are doing that research, because the things that are being bypassed by the flows or ignored by the flows are interesting opportunities, and things that are getting money, just on the basis of flows that don't necessarily deserve it are, can be interesting short selling opportunities. Mm-hmm. And so I think it creates more opportunity. But it's also, suggests to me that, a lot of the bull market of the past especially the last 3, 4, 5 years, is just a function of investor flows. And if investor flows switch the other direction, you inevitably get a bear market.
Mm-hmm. Well, what's funny is that I've had a few people on that talk about, now is the time where it's more of a stock pickers market, and at least for me, my impression is that it's never not a time or never not a stock pickers market, because there is just this latent inefficiency where, especially with the rise of passive investing, I mean, there's always going to be those individual stocks that are going to sneak through, and that if you did do the extra bit of research, there you go. Here's a couple ideas for you right there. What's your take on that?
Yeah, no, I agree. I think it's always a stock pickers market. I think, probably the flip side of that saying is that, the easy money has been made. And, you hear people kind of throw these kind of phrases around. But, I mean, you could have bought almost anything in 2009 and done really well over the last decade. Right. Going forward, it's clearly not going to be that easy. And so you're going to have to be more selective. You can't just buy anything and it'll go up, 3, 4, 5 fold. But yeah, I mean, I absolutely agree with you. I think it's always a stock pickers market. You look throughout the history of markets, and yeah, it pays to focus on, good, cheap companies over time.
Yeah, it's hard sometimes, because like you'll come across a company and you think you might be the first one. Especially, this is really mostly to microcaps, but like you might think you'd be the first one that discovered it, and next thing you know, there's 3 or 4 other people that might have just done a screen that day, or maybe even a week earlier, and then all of a sudden, this company that you just found, that you think it's at a reasonable price, that you've done all your research on, and next thing you know, it's already up tenfold, and you're like, oh man, like I thought I just found another, because it's just so much information so fast, right? Like,
yeah, but that's an interesting point that you bring up too, because I find that the greatest opportunities, I think passive has not only infected just the broad market, but it's infected value investing too. And so that you have money going into, essentially like a passive value strategy or a smart beta kind of value strategy. I think that's why I've never found a lot of use for screens for that reason, because, if a ton of money is flowing into these passive products, whether they're value based or not, that's going to mean that those stocks are not going to be I'm looking for things that are unpopular, underloved. And so if there's passive money flowing into them, that makes them less likely to be that. Mm-hmm. And so I think I found that things that are in value indexes are also much less likely to be. And I think this is one of the problems with value investing right now too, is that the things that I've found that are successful value investments over the last few years have been really idiosyncratic, unique type of opportunities. They really maybe didn't show up on value screens for whatever reason. But yeah, I mean, they and so they wouldn't show up in those value portfolios. And so, I think, it's a super interesting time for all of these reasons. But yeah, I think it's tough, people lament how value hasn't been working for a few years, and I look at that and I go, are you crazy? Value's been working great as long as you're staying away from the things that are crowded value trades, right? Value's supposed to be a kind of a contrarian type of thing, but if it's not contrarian, then it's probably not a worthy value investment.
I like that, crowded value trades. I'm writing that down right now. That's a good one. So this is my favorite question I love to ask. Jesse, what investing experience would you say helped shape your current approach to investing, or had the most impact on you in general?
The most impact? Well, I mentioned Ball Corp. I think to me it was very interesting in the 1999, 2000. And I was still at the hedge fund, and I'm watching these .com stocks go through the roof, and I'm watching another group of stocks that were just absolutely left for dead. One of those was Ball Corp, and to me it was a company that was super boring. I mean, you start doing the research, and you're like, really? How can this be a good investment? And, I probably should have put a ton more money into it. But it really taught me that it doesn't really matter how boring the line of business is or whatever. When you get a management team in there that knows what they're doing and is willing to put their money where their mouths are, almost any type of business can be exciting. But I think most of the things that I've learned have been through losses. I mean, I've had some painful losses at times over the last 20 plus years, and those experiences have taught me, you burn your hand once on the stove and you go, okay, I'm never ever doing that again.
Right.
So I think losses. I think it's helpful to think, and I think I got this from one of the Market Wizards books. It's helpful to think of losses as tuition at the school of trading. Everyone's going to have losses, and you usually learn a lot more from your losses than you do from anything.
That's for sure.
You do making money. So I think it's important to look at it that way and not feel bad when you lose money. Everybody does. But the important thing is to learn from it and say, I'm not going to make that same mistake again.
So then, Jesse, what advice do you have for new investors that are looking to enter the market?
Well, I think the most dangerous advice right now is for new investors is that there's only one way to invest, is that you need to put your money into the S&P 500 and just, hold it forever. I really do believe strongly that everybody needs to find their own way. Everybody has their own unique risk tolerance, their own unique values and, strengths and weaknesses. And everybody needs to find their own way to invest that suits their own sensibilities. And so, I really don't think, I think a lot of investors also spend time trying to emulate another successful investor. And you'll never be able to do that successfully. I think the thing to do is learn from, certain techniques from these guys. And so, I've learned from Warren Buffett and Paul Tudor Jones and Stan Druckenmiller and whoever I can actually learn about and study. I've tried to pull things from each one of those people in trying to develop my own style, because you have to come up with something that you believe in through, good times and bad, and that you're going to be able to stick to. And because if you don't, that's when you're going to start running into problems, and you're going to lose money simply because you don't have faith in the process. And so you have to find something that you can believe in and have confidence in. And that's really unique for each individual person, I think.
That's great advice. I love that advice. So then, rounding the bend here, Jesse, where can my audience go and find more information about all things Jesse Felder?
I write a blog at thefelderreport.com, and I spend a lot of time on Twitter. I do tons of reading. It's usually more macro kind of focused stuff, but it's just at Jesse Felder on Twitter.
Perfect. Well, Jesse, thank you so much for sharing your insights and thoughts here with me today, and I'm really excited to share this interview with everybody.
That was a blast, Robert. Thanks for having me. Appreciate it.
Thank you.
Thank you all for tuning into the Planet MicroCap Podcast, and thank you, Jesse, again for coming on to the program. You can access the podcast by going on to stocknewsnow.com under podcast, go to podme.com and search Planet MicroCap Podcast, or on iTunes and search Planet MicroCap Podcast. Stay tuned for the next Planet MicroCap Podcast, where we'll have our next guest to discuss all things microcap. If you have any questions or comments about the podcast, please send an email to info@snnwire.com. I'd love to hear from all of you. This podcast has been brought to you by SNN Incorporated, publishers of StockNewsNow.com, the official microcap news source, and the MicroCap Review magazine. I'm your host, Robert Kraft, and thank you again for joining me on the Planet MicroCap Podcast. Have a great week, everyone.